Monkey has a dream. Right now, he's staring at a single, shriveled banana on a dying tree. But in his head, he's already walking through a high-tech plantation with automated irrigation and thousands of perfect crops. Building this vision requires 10,000 monkey bucks. Monkey checks his pockets and finds exactly zero. A traditional bank loan is out of reach. Banks generally require collateral, physical assets they can seize if the borrower can't pay. An everyday monkey with no savings and a dying tree has nothing to offer a lender. If Monkey can't find a way to gather that capital from the outside, his vision remains a drawing on a piece of paper, and the business never starts. Instead of hunting for one ultra-wealthy gorilla to fund the whole project, he decides to break the ownership of his future business into small, affordable pieces. This is the mechanic of fractional ownership, dividing a single large asset into smaller units that multiple people can own simultaneously. To reach 10,000 bucks, Monkey divides his plantation into 100 equal slices. The entry price is exactly 100 bucks a slice. By selling these to neighbors, the contributions add up. Selling all 100 hits the target to begin construction. This structure shifts the burden of funding from one person to 100. It allows a project that would be impossible for an individual to become a reality through the collective savings of the community. Monkey takes his paper shares to the market square to find buyers. This is his initial public offering, or IPO. The other monkeys are cautious. They've worked hard for their savings, needing a clear financial reason to risk that money on a new plantation. Monkey offers a dividend. Because a share represents 1% of the company, it entitles the holder to 1% of profits. When the plantation sells bananas, a cut of that revenue is funneled back to investors as a cash payment. The deal works. The investors buy the shares, Monkey gets the 10,000 bucks, and soon the high-tech plantation is built and yielding record crops. The visionary gets the upfront capital to build, while the neighbors who funded him secure a new stream of passive income. A few months later, the situation changes. One of the original investors needs cash immediately to fix a leaky roof, while a new monkey who missed the IPO is looking for a way to get in on the plantation's success. The investor doesn't ask Monkey for a refund. Instead, they sell their share directly to the new buyer. This environment where individuals trade shares with each other is called the secondary market. Because the plantation is now highly profitable, more people want to own a piece of it. This high demand drives the share price up, ticking from 100 bucks to 500. When the trade is made, the original investor walks away with a 400-buck profit. They grew their wealth without ever having to pick a single banana. On the secondary market, the value of a stock is constantly moving, reacting to the physical performance of the business and the public's desire to own it. If we zoom out, we see this same process happening across thousands of different businesses, from coconut oil refineries to Vine transportation networks. This vast, interconnected network of people buying and selling fractional pieces of companies is the stock market. However, this engine of wealth creation is powered by risk. If the plantation's trees wither or the business fails to sell its crops, those paper shares lose their value. If the company goes bankrupt, the investors can lose everything they put in. The market is a continuous, calculated game of risk and reward, a system where everyday people bet their own savings on the success or failure of the future.